You built the foundation. You raised the walls, you put the roof on. Your money is finally working, invested, compounding, growing while you sleep. But here is what nobody warns you about. Everything you have built is still exposed. Not to the market, not to bad luck, to the tax code. Most people will pay more in taxes over a lifetime than they will ever pay for a home. And most will pay far more than the law actually requires, simply because nobody ever showed them the shield. In our last structure, we put the roof in place. Today, we raise the shield. The legal shelters that keep what you earn, protect what you grow, and defend everything your wealth stands behind. Stay to the end. I will hand you a 5-step shield check you can run this week in about 15 minutes to find exactly where your money is still exposed, including the one account the tax code rewards 3 separate times and the 61-day calendar window that quietly erases losses people thought they had banked. The shield goes up last for a reason. Tax shelters are not piggy banks. They only protect money that is actually flowing in. And money locked in the wrong shelter at the wrong time can trap you with penalties that compound faster than returns. So this episode assumes the roof is on. Your cash buffer is standing, your investing system runs every month without you. Now the question changes. It is no longer how do I grow it? It is how much of the growth do I get to keep? Because growth taxed away every single year never gets to compound. And compounding is where the fortune lives. Picture 3 rooms. In the first room sits a taxable brokerage account, and every gain pays a toll along the way. In the second, a traditional retirement account. The toll is delayed until you withdraw. In the third, a Roth account. You pay 1 toll on the way in, and then every dollar of growth passes untaxed for the rest of your life. Here is what that toll costs in real numbers. 2 investors each put $30,000 to work, earning 8% a year for 25 years. The sheltered investor ends with about $205,000. The taxable investor, paying 15% on the gains every single year, ends with about $155,000. Same market, same skill, same patience. A $50,000 gap created by nothing but the account the money sat in. That is tax drag, and the shield exists to eliminate it. The first move is called asset location. Investments that throw off ordinary income, bonds, real estate investment trusts, high turnover funds, belong inside tax-deferred accounts where that income is sheltered. Boring, tax-efficient index funds can live in the taxable room, and your highest growth assets belong in the Roth room, where the biggest gains of your life pass completely untaxed. Now, the strongest shelter most people never fully use, the health savings account. It is the only account in the tax code with a triple advantage. Money goes in tax-deductible, it grows tax-free, and it comes out tax-free for medical costs. Not deferred, free at both ends. In 2026, you can contribute $4,400 with self-only coverage, or $8,750 with family coverage, plus $1,000 more at age 55 or beyond, as long as your health plan qualifies as high deductible. Here is how the wealthy actually use it. They pay today's medical bills out of pocket, keep the receipts, and let the account stay invested. A family contributing the family maximum every year for 20 years at 7% builds roughly $360,000, every dollar available tax-free for healthcare. And after age 65, the account works like a traditional retirement account for everything else. Next, the Roth conversion ladder. In any year your income dips, a sabbatical, a business transition, the gap years before Social Security, you can move a slice of traditional money into Roth and pay the tax on your terms, in the lowest brackets. Picture a single filer in a gap year converting $40,000. The $16,100 standard deduction shelters the first slice, and the rest is taxed at 10 and 12%. Total tax on the whole conversion, about $2,600, an effective rate near 6.5% for tax-free growth on $40,000 forever. And if your income is too high for direct Roth contributions, the front door fully closes above $168,000 single or $252,000 for couples in 2026, the back door stays open. Contribute to a traditional IRA without the deduction. then convert it. Some workplace plans go further. The Mega Backdoor uses after-tax contributions up to the $72,000 total plan limit, which, with a typical employer match, can move over $40,000 a year into Roth. Then, the shelter hiding inside your taxable account, tax loss harvesting. When an investment falls, sell it, lock in the loss, and immediately buy something similar, not identical, so your money stays invested while the loss erases gains. A $5,000 loss offsets $5,000 of gains, saving $750 at the 15% rate. If losses exceed gains, up to $3,000 a year can offset ordinary income, about $660 saved in the 22% bracket, and the rest carries forward. One trap, the wash sale rule. Repurchase the same or a substantially identical investment within 30 days before or after the sale, a 61-day window, and the loss is disallowed. Finally, the outer shield, how assets are titled. A $1 million umbrella liability policy runs roughly $300 to $600 a year and stands between a lawsuit and everything you own. Rental property belongs inside a limited liability company, so a problem at the property stays at the property. And beneficiary designations plus transfer on death instructions pass accounts straight to the people you choose, bypassing probate, but only if they are current. Now the mistakes that crack the shield from the inside. Mistake 1. Sheltering in the wrong order. Chasing exotic strategies while leaving the employer match or the health savings account unfunded. Free money goes first, always. Mistake 2. Converting a huge slab of money in a high income year and spiking yourself into a bracket you never needed to visit. Convert slices in low years, not slabs in high ones. Mistake 3. The accidental wash sale. Repurchasing a fund you just harvested or letting automatic dividend reinvestment do it for you inside the window. Turn reinvestment off before you harvest. Mistake 4. Selling for the loss and then sitting in cash, losing the recovery to save a little tax. Stay invested. The position matters more than the deduction. Mistake 5. Treating the health savings account like a checking account and spending it every year instead of letting it compound. And mistake 6. Stale paperwork. An ex-spouse still listed as your beneficiary, a rental held in your personal name, or a 3.8% investment surtax blindside above $250,000 of income for couples. Shields fail at the seams, never the center. Here's the shield check. 5 steps, run once a year. Step 1. Shelter first. Fund the health savings account, capture the full employer match, then the individual retirement account. $7,500 each in 2026. Step 2. Locate. Ordinary income assets into tax-deferred efficient index funds. Taxable, highest growth into Roth. Step 3. Convert. In low income years, move a slice to Roth and fill the low brackets on purpose. Step 4. Harvest. Every December, scan your taxable account, bank the losses, respect the 61-day window. Step 5. Title. Umbrella policy in force, rentals inside the company, every beneficiary form current. Run all 5 and a working couple can shelter more than $72,000 this year alone, money that would otherwise compound with a leak in it. Your one action, the 15-minute shield check. This week, open every account you own, verify every beneficiary, and raise one shelter contribution by 1%. If this raised your shield, subscribe, because next we seal the vault. Every example here is an illustration, not advice. Talk with a qualified tax professional about your own numbers, because in the next structure, we will show how the vault, your legacy, estate, and generational transfer plan is sealed, now that the shield around your wealth is fully raised.